Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about extrinsic value dynamics. And I gotta tell you guys, I'm really excited about this one because I have noticed that this is a subject that a lot of traders have issues with, and especially when they start thinking about in the money options, out of the money options, at the money options, and how different extrinsic value is from intrinsic value, and how they move pretty much, although in a related manner, pretty much independently from each other. So let's get right to it, and I hope that this really helps you guys, because understanding this is going to make you better traders. So to begin with, we know that an option price is made up of intrinsic value and extrinsic value. Intrinsic value is the tangible value, anything that is in excess of where the strike price is. So for calls, if the price of the underlying is above the strike price, that portion is intrinsic. For puts, the other way around. So if the price of the underlying is under the strike price, then you have some tangible value called intrinsic. Anything in excess of that is in an option is called extrinsic or time value. So in the money options have both intrinsic and extrinsic value, and out of the money and at the money options have only extrinsic value, no intrinsic at all. So anything that has a delta approximately above 50 is going to have intrinsic and extrinsic value, and anything that is at 50 or less is going to be at the money or out of the money, and is going to be only made up of extrinsic value. So intrinsic value depends on where the underlying price is. So for a certain strike price, or for a certain option with a certain strike price, the where the underlying price is the only factor that we need to consider when we want to figure out what the intrinsic value is of an option. So it doesn't matter what the implied volatility is. It doesn't matter which month it is. It's only based on a comparison between the underlying price and the strike price. Extrinsic, on the other hand, depends also on the underlying price as it relates to it being compared to the strike price, but also depends on implied volatility and also time to expiration. So the extrinsic or time value depends on these three factors. So an option that has a longer time to expiration is going to have the same intrinsic value, but the extrinsic is going to be affected, giving it a higher extrinsic and an overall higher value to the option. And the same thing happens with implied volatility. A higher level of implied volatility is going to be reflected in a higher value of extrinsic or time value, and also an overall higher option value. So this is important to understand. Intrinsic doesn't depend on implied volatility or time, just straight up price versus the strike price. That should be enough, and that is enough for you to determine what the intrinsic value is. And extrinsic, you have to know where the price is if you want to see it when you compare it to the strike price, and also what the level of implied volatility is, and what the level of, or what the time to expiration is. So now let's take a look at this graph. So what I've done here is I've plotted the I've separated out the intrinsic value from the extrinsic value in the value of an option. So for a certain option with a certain strike price, we're going to analyze what happens when price goes from a low value to a higher value, and as it changes from the option being out of the money to in the money, and how extrinsic and intrinsic value change. So and what we're graphing here, we're plotting here is the stock price versus the value of the option. So the price of the option, the complete price, not the intrinsic and extrinsic. We're gonna break it down here, but the full option value. So to start with, we start, and right away there's something very glaring and apparent here. It is that intrinsic and extrinsic are completely different. Intrinsic only depends on the price, as we were saying. So anything that's when the price is below, and remember, we're analyzing a call here, but the same analysis applies to puts only on the other side, so pretty much reversed. But let's talk about calls. So when you start analyzing calls and you have the strike price and the price is below the strike price, the value of the option is going to be made up of only extrinsic. And this extrinsic value, as you can tell, follows a curve that is very similar to a curve that we've already looked at, which is the normal distribution, the bell-shaped normal distribution curve. In reality, it's more closer to a log-normal distribution, but we're not going to go into a lot of details. Just conceptually, we want to understand the differences between intrinsic and extrinsic. So if you look here, the red graph, the red curve here is the value of extrinsic, the extrinsic value of the option, and it peaks right at the strike price. So when the price is equal to the strike price is when it has its maximum value. As it starts going far from it, either lower or higher, the value of the extrinsic value or the time value starts going down. Now, intrinsic is not like that. Intrinsic at the strike price, it has a value of 0, but as it starts getting in the money, it starts getting, and it's a one-to-one relationship. Basically, it starts going higher one-to-one with the option. So if it goes $2 in the money, the intrinsic value is going to be $2, because if you have a call, you can right away, and you have the strike price, you have a call option with this strike price. What you can do is just go to the market and exercise and buy at this price and sell at this price. So do you have the difference between the price and the strike price as the real tangible value for that option. So we start the analysis again. So if we go from the price starting here, it only has extrinsic value, no intrinsic value at all. And then at the strike price, starts gaining intrinsic value, but at the same time, the extrinsic value starts going down. Okay, so an option that's in the money, or if you want to make it even more extreme, an option that's deep in the money is going to, even though it's going to look like a very large option, and you can think that it has a lot of value, you need to understand that most of that value is intrinsic value, and the extrinsic value is very little, as you can see here. So for example, if we analyze this point here, the intrinsic value is most of the value of the option. It's only this difference that represents this value that the option is overvalued by. So many traders think that when you go in the money, the extrinsic value continues to grow with the option, and in reality, that's not the case. You're gaining only intrinsic value, but you start losing extrinsic value. Of course, if you're long the call and the price starts going higher, then well, you don't care about it too much, and you probably don't start analyzing why you made money. You just made money and you're happy about it. But if you want to be specific, and if you want to start using strategies that are a little bit more complex, or strategies that rely more on longer term holdings and maybe doing some adjustments or rolls, then you need to understand that extrinsic value, as you go in the money or out of the money, it starts going much lower, and it peaks right at the strike price. This is something that not a lot of traders understand. So hopefully this is something that is clear and that needs to be understood. And once you understand this, you're going to understand the basic premise of adjustments, rolling out in time, etc. But you need to have this information clear in your head, because if you don't understand it, you're going to be faced with situations where you don't really understand why a certain roll was made for a debit instead of a credit, or an adjustment didn't give you the results that you were hoping for. So this is very important to understand. So in summary, intrinsic value only exists for prices, for underlying prices or stock prices that are higher than the strike price, and extrinsic value exists for every value, for every price, but the value is the highest at the strike price and starts going down as you go further and further away from the strike price. So extrinsic value is the highest for the point where the stock price is equal to the strike price. So pretty much when the price is at the money, when the strike price is at the money. And extrinsic value declines as the stock price gets further and further from the strike price. So either in the money or out of the money. This is key to understand this. In the money, out of the money for traders. If you're talking about a call, well, out of the money, you think of the option as it being something that's very small and insignificant, and in the money, you think about the option being bigger and more significant. In reality, it's only intrinsic value that's the difference in that respect. The extrinsic value for both in the money and out of the money are pretty much symmetrical. So you should always keep this in mind, that extrinsic value peaks at the money and starts going down when you go to the extreme, so in the money and out of the money. Now, another thing that's very important to see here is that the little note that I included here, extrinsic value is driven by both implied volatility and time to expiration. Okay, so in addition to where the price is, so where the price is with respect to the strike price, you can see here how it changes, but also implied volatility and time to expiration are going to modify the curve that represents the values for extrinsic value. Now let's take a look at the same graph that we were just looking at, and we're going to compare it to another graph where I've modified the implied volatility and the time to expiration. So as you can see, here we're analyzing two situations. The first one is the one that we just looked at, and then the second instance here is going to be where the option is the same option, but we've modified, we've either gotten more implied volatility, higher implied volatility, and or a longer time to expiration. So maybe we've picked the same option, so the same strike price, but a further month or a further expiration, or we've picked a different underlying that has the same characteristics but higher implied volatility. So the thing that's important to notice here is that extrinsic value is driven or determined by where the underlying price is with respect to the strike price. So we saw that here already, but also by implied volatility and time to expiration. So if we have a longer time to expiration or a higher implied volatility, as you can see the curve, I hope it's noticeable here, but the curve is, although the same basic shape, it's different in the sense that it's higher, it's bigger, it's larger. So you can tell here that the value, for example, at the money is higher here, and the values that are out of the money are also larger here and here, out of the money and in the money, so that overall the option is going to have a higher value at every point pretty much. And this is something that's important to understand, because we talked about the intrinsic value being the same and only depending on the difference between the price and the strike price. And you can see it visually here. If you look here, what you're seeing is that this line representing intrinsic value is exactly the same, and we pushed up the implied volatility and the time to expiration, and this line is the same. It doesn't matter, it's just price. But the little curve here that represents the extrinsic value, which is somewhat distributed normally, let's say log normal in reality, but let's stick with normal because it's something that pretty much all of us know from taking statistics in school or something like that. If you think about this as being a normal curve, a normal distribution curve, we are just pushing it up, pushing it higher at every point. And because of this, the options overall, and this is something that you probably noticed empirically just by trading, is that that options that have more time to expiration are higher in value. Why? The intrinsic value is the same, is the extrinsic value that changes with longer time to expiration. And likewise, when you look at, for example, different underlyings, but that have the same different implied volatility, you're going to notice that the option with a higher implied volatility is going to be more expensive, not because of intrinsic. It's entirely because of extrinsic, which is what drives the optionality in option prices. So when you're an options trader, you need to understand that intrinsic is something that's static and doesn't change a lot, but extrinsic is something that's constantly changing because time is passing with each day, and also implied volatility fluctuates and is what the market or is the value that the market assigns to the potential future stock price movement. Now, if we think about this, and with all the all of these things that we've learned today, how can I apply it in real life? Well, one of the ways that you can think about this is, for example, here. I've changed this graph a little bit because I'm going to think about it in a way that a trader would. So I'm not plotting here the stock price anymore. I'm plotting strike prices. So this is when you go to your platform and you see all the different values that you can pick from different options. So basically all the different options that there are for you to select the options. You have the where the price is, you have the at the money strike. You have, for example, let's talk about calls, but it's the same thing for puts, only just flipping the graph. So you look at the at the money is the one with the highest amount of extrinsic value. Okay, you look at the in the money calls, for example, and the out of the money calls. So right away, if you understand what we talked about, now you know that yes, the in the money calls seem to be bigger and larger, but they're made up of mostly intrinsic value, not extrinsic value. Extrinsic value is pretty much just as little as what the corresponding out of the money would be. Okay, and this is something important to understand. So for example, this is not mathematically correct, but just like as a rule of thumb or as a back of the envelope exercise here, you could go, if the at the money is 100 and you see that the 70 strike call has a value of 32, well, you see 32 is a pretty big value, and the 130 strike price, so equidistant, even though I'm cheating a little bit, but just for the example, is trading at a value of 2. You can see 32 and 2. Oh, how different they are. Well, in terms of extrinsic, they're exactly the same. Okay, it's only the intrinsic value that drives the value of that option higher. So you need to understand this so that you can get a good picture or a clear picture of what's going on here. So now, okay, so we have this and we understand this. Now, what happens if I start looking at, for example, in this case, as you can see here, the we have the same strike price. Also, we're plotting the strike prices or the different strike prices. But if you look here, we've, for example, if we think about longer time to expiration, we have the front month and a back month. So when you, for example, want to roll out in time, and let's say, for example, you are short the at the money call, and you are just rolling it to the next month, what you're doing is you're taking this value. So the at the money is purely extrinsic value, and you're buying this one and selling this one, which is why you get a credit, because the extrinsic value is higher. Remember, there is no intrinsic for at the money. So that's why you're getting a credit. And the other way around, it works the other way around for when you are long a call and you want to roll it out in time, you have to pay the difference between this value, which is all extrinsic, and this value, which is all extrinsic, but with a longer time to expiration, there is more time value. That's why it's called time value in this case. Okay, so now more important than that, when you start going into out of the money or in the money, especially in the money, you start losing track of this, because when you have an in the money call, for example, the value is now let's say more complex, because it's made up of both extrinsic and intrinsic. So for example, if you wanted to, let's say you are short a call here, which has gone against you because now it's in the money and it's pretty much deep in the money. You have a large value and you want to keep the position alive and you want to extend the position for a month or longer. Then you go, okay, so what I'm going to do is I'm going to roll it, because if I'm short a call here and then I go and short and go short the same strike, but at a longer time to expiration, so a further away month, okay, that point I'm going to get a credit. So yes, you would get a credit, but take a look. You're getting the same intrinsic, that doesn't change, but what you're getting is you're pretty much buying this much extrinsic and you're selling this much extrinsic. So the actual credit for you is going to be very minimal. Why? Because you're in the money. Okay, and in the money options have little extrinsic value. They might look big, but it's mostly intrinsic value, not extrinsic value. So when you roll out in time, you're going to have this situation. Okay, so in that case, you would have to start thinking about, for example, getting closer to at the money. Every time you get your strike price close to the at the money, you're going to be getting a higher value of extrinsic. So if you want to sell it and you want to profit from it, then what you want to do is you want to be in a strike price that, or in options with a strike price that's not very far away from the at the money, because otherwise this is going to start dwindling down until it's pretty much negligible. Now, another thing that I didn't mention was that this curve with each day that passes starts getting smaller and smaller and smaller and smaller until you reach the extreme point, which is when it expires. So the moment it expires, you no longer have any extrinsic value and you're left only with intrinsic value, which is what remains when the position expires or when the option expires. It ceases to exist, but you can exercise it and get, or if you are on the other side, you're going to be assigned, but you can exercise it and get the intrinsic value that you get. So intrinsic value is always there, and it's only time value that adds to the overall option value. So this curve is dynamic. It changes, and it also changes if implied volatility goes higher. Let's say, for example, now we're not going to talk about a different expiration. Let's take a look at a second example. What if it goes from a low implied volatility to a high implied volatility. And this happens quite often. This happens, for example, when there is an event that makes traders know that there might be a big price move coming. So if that's the case, then they start what traders call pumping in a higher implied volatility, because they know that the future volatility or future realized volatility is going to be higher because there's an event coming up. So for example, the clearest example that we have, and we have it all the time, is earnings results. So when a company is about to release their results, their earnings results, then they know that there's going to be they meaning traders know that there's going to be a move either way, up or down, but it's going to be a move that's not going to be like a normal day-to-day move. So they pump in high implied volatility, so the options start getting bigger in value exclusively from extrinsic. This is what's important to understand. Only extrinsic is the thing that changes. Intrinsic never changes. So the implied volatility is going to be higher, and at that point, if you want to be a buyer, well, just be aware that you're buying inflated volatility. So now you need a bigger move in order to counteract the amount that you already paid for it. And if you want to sell it, and you sell it, and the move is less than it was than the markets were predicting, then you're gonna make money. But if the move is larger, then you're going to lose money. So basically, implied volatility, betting on implied volatility, buying it means that you're thinking that the move is going to be larger than expected, and selling it means that you're betting that the move is going to be smaller than expected. So that's another example for a situation where in this case, for the second example, same month, same expiration, but volatility changed. Now extrinsic value changes, and the overall value of the option is going to be higher, but it's exclusively because of extrinsic value. So now let's quickly go to the trading platform just to take a look, and it's going to be just a quick glance at extrinsic values, so you can see this in action and see the at the money being the one with the highest extrinsic value. So now we're on the trading platform, and we're going to take a look at, in this case, Google, so Alphabet, GOOGL, a ticker symbol. I've pulled up the extrinsic value as a column here, so you can take a look. And you can take a look here. So at the money is pretty much 1270 because 1269 doesn't exist. So we go to the 1270. And we can see that the 1270, in this case, for example, for calls, is right here, $49 is the highest value that we have. And then as you start going in the money or out of the money, starts going down. Same thing for puts. If you look at the money, we have this 49 value, which, by the way, it's pretty similar to this one. We're gonna look at that in a different lesson. And if you go out of the money on puts, it starts going down. This is the extrinsic, this column. And if you go in the money, it also starts going down. So you know that this in the money put is made up of both extrinsic and intrinsic, because this is in the money. So this strike already has $30 pretty much of intrinsic value. Same with the puts. Now, if we go to the next month and we look at the same information, now the 1270 is still although this is real data, so this is changing, but still 1270 is the at the money. And you can see that the 1270 is still the one with the highest value, 71 here. But this at the money value is higher than this at the money value. So longer time, we have a higher value of implied volatility. So this is what would be the difference between expirations. And same thing is if you go in the money or out of the money, these values start going down. Same with the puts. Okay. And the same would happen if the implied volatility was higher or lower. This extrinsic value is the one that's going to be pumped up if implied volatility is higher, or if this implied volatility is lower, is going to be decreasing from the value that you had before. So in this case, for example, it's hard to tell because all the values, they're changing at the same time. But for example, for the May expiration, the implied volatility is 42%, and for the June expiration, the implied volatility is 38%. So it's the front month in this case, so the one that has less days to expiration has a little bit of a higher value of implied volatility, and the back one has a little bit less implied volatility. But because this one has a longer period, it's reflected in the extrinsic value. So now you've seen how it works on the platform. You've seen the extrinsic in reality, and now you know what the difference is between intrinsic and extrinsic, and how intrinsic doesn't depend on implied volatility or time to expiration, but extrinsic value, which is what gives options their optionality or their main option characteristics. Now you know that intrinsic value depends on the price compared to the strike price, and also implied volatility and time to expiration. So I hope this was clear, and I hope that you guys got something positive out of this, because this is information that's going to help you a lot as a trader. Now, when you start thinking about rolling out in time or adjusting the strikes, moving this up, moving this down, etc., now you're going to understand that yes, I'm doing something with intrinsic, but extrinsic behaves in a normal distribution like way, peaking right at the money. So this is going to be key for you to make good trading decisions. And I hope that this helps you guys out in the future. And I hope that you can still tune in and see our other lessons, and stay tuned for lessons that we're going to be releasing in the future. Thank you very much. Goodbye.